Thank you, and welcome to the Briefcase, where we talk all things business, investing, and real estate. Today, we're going to be talking about taxes, and I'm going to be giving a full breakdown. Let's get into it. Most real estate investors overpay taxes, not because they have to, but because they don't know the rules of the game. And here's the part nobody tells you. Investors save hundreds of thousands of dollars using just one of the strategies we're covering today. So if you're paying full freight to the IRS, this video might save you thousands. So make sure you watch. Tax code number 1, cost segregation plus bonus depreciation. Let's start with the heavyweight. If you understand this one, you're already playing a completely different game. The concept: when you buy real estate, the IRS lets you depreciate it over time. With residential, it's 27 and a half years. With commercial, it's 39 years. But here's the twist. Not everything in that building actually lasts 27 and a half years. Some parts wear out faster. Carpet, appliances, lighting, and HVAC. So instead of depreciating everything slowly, you can separate the components and accelerate the depreciation. That's cost segregation. And then comes the bonus depreciation. Bonus depreciation lets you take a massive chunk of that depreciation up front. The translation: you create a paper loss, even if your property is making real cash. The real example: you buy $1 million property. The cost segregation study identifies $300,000 worth of assets that can be accelerated. With bonus depreciation, you might write off $200,000 plus in year 1. You didn't lose money. You just told the IRS you did, and the IRS agrees. Why this matters: that $200,000 loss can offset rental income, business income, and in some cases, even W-2 income. We'll get to that. This is how investors with strong cash flow show zero taxable income. Tax code number 2, section 469. This is the real estate professional status, or REP. This is where things get interesting, because normally rental losses are considered passive, and passive losses can't offset your active income, like your job. But section 469 introduces a loophole, and it's a big one. The rule: if you qualify as a real estate professional, your losses are no longer passive. They become active, and active losses can offset active income. The requirements: these are simplified: 750 hours per year in real estate activities, and 2, more time in real estate than any other profession. That's it. The real world strategy: let's say you make $300,000 at your W-2 job, and your spouse qualifies as a real estate professional. You run out cost segregation, and your properties generate $200,000 plus in losses, and suddenly your taxable income drops dramatically. This is not theory. This is happening every day. High income earners using real estate to legally reduce or eliminate their tax bills. Tax code number 3, section 1031, exchange. This one is simple and powerful. The concept: when you sell a property, you usually pay capital gains tax, but under section 1031, you can defer those taxes by reinvesting into another property. The translation: you sell, you don't pay taxes, and you reinvest the full amount. Your example: you bought a property for $500,000. You sold it for $800,000. That $300,000 gain, normally you'd owe taxes on that first. With a 1031 exchange, you roll the entire $800,000 into a new deal. Taxes today is $0. Why this is so powerful: because you're compounding with pre-tax dollars. It's like investing with the government's money, interest free. And if you keep doing this over time, you build massive wealth without triggering taxable events. Tax code number 4, section 121. This is the primary residence exclusion. This one feels almost too generous. The rule: if you live in a property for 2 out of the last 5 years, you can exclude 250 grand in gains for single, or 500 grand if you're married, completely tax-free. The strategy: live in flips. You buy a property, you improve it while living there, you sell it after 2 years, you keep the gains tax-free. Why this works: you're combining appreciation, forced equity, and tax-free exit. It's one of the most underrated strategies in real estate, especially early in your investing journey. Tax code number 5, section 199A, QBI Deduction. Now let's talk about income, because not all income is taxed equally. The rule: if you have qualified business income, you may be eligible for up to 20% deduction. Yes, that includes rental income. But of course, you have to structure it properly. The example: you make 100 grand in rental income. You might only be taxed on 80 grand. That's a straight 20% haircut before rates even apply. The catch: there are income thresholds and rules around wages, property basis, and business structure. But the takeaway is simple: the tax code rewards people who treat real estate like a business. Tax code number 6, the short-term rental loophole. This is the one that's been quietly blowing up, for good reason. The problem: normally you need a real estate professional status to use losses against active income. The loophole: short-term rentals don't follow the same rules. If the average stay is under 7 days, it's not classified as a rental activity, which means you don't need real estate professional status. You just need material participation. The definition of material participation is, and this is simplified, your activity involved in managing the property, which includes communication, pricing, and operations. Why this is huge: you can buy a short-term rental, run cost segregation, and generate massive losses, and use those losses to offset your W-2 income without qualifying as a real estate professional. This is the clip-worthy moment. This one loophole alone can wipe out your W-2 income. And yes, the IRS literally allows this. Tax code number 7, opportunity zones. Now let's zoom out, because this one is about long-term wealth. The concept: opportunity zones are designed areas where the government wants investment, so they offer you tax incentives. These benefits may include deferred capital gains, reduce capital gains over time, or eliminate taxes on new gains if held long enough. The example: you sell a business or property, you reinvest the gains into an opportunity zone fund, you defer taxes, and if you hold long enough, the new gains can be completely tax-free. This strategy is called capital placement, not just tax savings, but long-term positioning. Now for a case study. Let's say you have 500 grand in income and pay 0 taxes. Let's put it all together, because individually these are powerful, but stacked, that's where things get interesting. Here's the scenario. The investor earns 300K W-2 income and 200K from real estate rentals. That total is 500 grand. What they do is buy a short-term rental, run cost segregation, generate 250 grand in losses, material participate, and apply losses against total income. The result? Taxable income drops close to zero. Cash flow remains strong. Your net worth continues growing. And what's actually happening? They didn't avoid taxes. They followed the incentives built into the system because the tax code is designed to reward investment, risk-taking, and economic contribution. And a quick fun fact about these taxes before you leave that most real estate investors completely miss. There's actually a tax strategy in the US tax code that lets investors legally pay zero in taxes, even while making hundreds of thousands, sometimes millions in profit. It's called cost segregation, paired with bonus depreciation. Here's the wild part. On paper, you can show a loss, even if you made real cash. So imagine you earn 200 grand in rental income, but through depreciation, the IRS sees it as a negative income. That loss can then offset your W-2 job, your business income, or other investments, depending on how you qualify. That's why you'll hear stories of real estate investors paying nothing in taxes for years. And no, it's not a loophole. It's exactly how the tax code was designed to reward people who invest in real estate. Crazy, right? Now, thank you for watching the briefcase today. If any of those 7 tax codes confused you, or you have something insightful to say about them, please comment down below. If you enjoyed this video, make sure to like and subscribe. Now remember, stay smart.